Hello, I'm Jen Kohls of Richardson Capital Management, and I'm joined with Dan Brown, our Director of Investment Management. We're here to provide the economic and investment update for October 2024. In reviewing the financial markets in October, stocks were lower for the month. The S&P reached another all-time high late in the month. However, large caps still finished lower, and international stocks underperformed the most. Fixed income posted negative returns across most categories. Dan, what are the reasons for the losses to fixed income this past month?
Sure, Jen. So most of these videos, we spend our time talking about the stock market and less on the bond market. So
Mm,
maybe let's spend a little bit more time talking about the fixed income markets this time around. And we saw some interesting activity in the month within the fixed income markets. So you might remember last September, we had the first Federal Reserve interest rate cut.
mm.
And over the course of the month of October, we actually saw interest rates rise, which I think caught some investors by surprise. I have a couple explanations as to why that is. One, I think investors thought that the Federal Reserve would have to cut interest rates to kind of support economic growth. And we can see fairly clearly that the US economy is doing pretty well. So looking at things like the monthly employment report, weekly unemployment claims, retail sales, consumer confidence, the GDP report that we saw late in the month, pretty solid. So I think some expectations about how much the Fed would have to cut interest rates to support growth have kind of been removed from consumer sentiment. The other reason is we've got an election coming here very shortly, and there's a little bit of investor concern around deficits and the debt. So if we look at both candidates and what they're talking about doing, neither candidate at the moment seems real serious about cutting the deficit or debt. So that has some investors unnerved. Again, another reason to push interest rates up. So bond prices lower, interest rates higher.
We expect that the Fed will continue watching economic indicators in determining the size of the next rate cut. Dan, what are some noteworthy indicators we've seen this past month?
Sure. So we've got another Fed meeting coming up November 7th, and we expect about a quarter point cut from the Federal Reserve. As far as indicators that we're paying attention to, probably the most timely and most important is just labor market indicators. So we've seen the monthly employment report that always comes out, usually the first Friday of every month, be pretty strong. So this past month, early October, very strong employment report, unemployment rate right around 4.1%, still very healthy. And then another important economic reading that we saw late in the month was gross domestic product, or GDP. And that came in at 2.8% annualized. So just a little bit less than the prior quarter of 3%. So overall growth is still doing relatively well for the US economy here in 2024. And we would expect going into 2025 that a lot of that growth will continue. So again, as far as what it means for the Federal Reserve, maybe investors got a little bit ahead of themselves, expecting a lot of interest rate cuts from the Federal Reserve, and maybe they don't need to cut as much as investors were thinking as recently as say 2 months ago.
Last month, we reviewed the performance of the stock market during Fed Reserve interest rate cutting cycles. Dan, what about the performance of fixed income markets during Fed Reserve rate cutting cycles?
Sure, Jen. So let's just real quickly recap what we showed last month, and that is stocks tend to do pretty well during Fed rate cutting cycles that are associated with kind of a soft landing, which we still think we're in. So we still think that's the most likely scenario. And as far as fixed income performance, the chart we're showing shows that fixed income categories perform, pretty consistently, positive during Fed interest rate cutting cycles. So in the graph here, we're looking at the last 7 interest rate cutting cycles, and we can see that intermediate term fixed income generally performs the best, and in some cases, actually most cases, slightly outperforms the stock market, the S&P 500. So very encouraged by this data, and if we think about the next year or so, we wouldn't be surprised if fixed income maybe slightly underperforms these historical averages, mainly because, as we've talked about, investors kind of pulled forward a lot of those expectations around Fed cutting into the summer months. So, for example, July and August were very strong months for fixed income performance as investors were anticipating the rate cuts to begin. So again, still expecting solid returns from fixed income, but maybe a little bit less than what we're showing here from a historical perspective.
With all that in mind, what is our outlook for the economy and the financial markets?
So we still retain a positive outlook. As we've talked about, the stock market's done pretty well the past year or so. So the S&P is up 10 of the last 12 months, up about 40%. Looking out over the next year or so, we still envision positive returns from the stock market, just not nearly as strong as what we've witnessed over the past year or so. So we've talked about a number of the positives, biggest one probably being the labor market. Unemployment rate still historically low. Consumers are spending, and we've got a global easing cycle. So last month, we count that there were 25 global central bank interest rate cuts. We've got another one coming up probably the first week of November with the Federal Reserve. Wouldn't be surprised if there's a little bit of volatility, though, in the next month or two with the US elections. And again, maybe investors paring back their expectations around Federal Reserve interest rate cuts.
Thank you for sharing your insights, Dan, and thank you for watching. As always, we appreciate your continued trust and support.